Danny from Wicked Cool Finance here. Please like this video and subscribe to my channel. Now today we're going to cover what is a bond, how do they work, what makes them go up and down in value, what makes interest rates go up and down in value, what ultimately makes a bond safe, the different types of bonds, and please stay to the end of this channel because you're going to get a big bonus. I'm going to cover one critical thing to investing, and that is why mutual funds that invest in bonds are horrible investments. You really need to understand that. Now, first thing, what is a bond? Well, when you buy a bond, whether it be a corporate bond or a treasury bond, what you're doing is you're lending that corporation money, or you're lending the federal government money. That's how the government finances their operations. We'll get into that a little deeper later on in the video. But a bond is essentially a short-term loan to either a municipality, the federal government, or a corporation. Now, what makes bonds go up and down in value? Let's keep this very, very simple. No need to complicate it. Okay, let's say today, you buy a bond for $1,000. When bonds are new, whether they be a corporate bond or a treasury bond or what have you, we'll get into the different types. When you buy a bond new, they typically cost $1,000. So let's say you buy one treasury bond today, and that treasury bond pays you 10%. Okay? So 10% of $1,000 means that you're going to get $100 a year. All right. Let's say next month you have some extra money and you want to buy another bond. So you're going to buy another treasury bond. But this time, interest rates have gone up quite a bit. So you take your $1,000 and you buy a United States Treasury bond. But this time, that bond is going to pay you 20%. Well, that's pretty cool. So you're going to get 20% of $1,000. You're going to get $200 a year. Well, just last month, you bought a bond for $1,000 that paid 10%. And now you spent $1,000 and you bought a bond that pays 20%. So interest rates went up. Well, you're not going to be able to sell that $1,000 bond that pays 10% for $1,000 when you can buy one today that pays 20%. No. So understand that when interest rates go up, the value of bonds goes down. Now let's look at the flip side. Let's say yet another month later, you want to buy another bond for $1,000 from the government. Okay, only this time you take your $1,000, but interest rates have fallen. Let's say that interest rates have fallen to 5%. All right, so you take your $1,000, the bond pays 5%. What are you going to get per year? $50. Okay, well, interest rates have fallen. So now the new bond, if you can only get a bond that pays 5%, well, what about the bonds that you bought last month and the month before that paid 10 and 20%? They've actually gone up in value because interest rates went down because you can't buy a new one for 10 or 20%. You can only buy a new one that pays 5%. So when interest rates go down, bonds go up. When interest rates go up, bonds go down. Okay. Now, what makes interest rates go up and down? Well, the federal government is ultimately the one that sets the interest rates in the United States. And the government is typically trying to achieve a couple of things. They're trying to keep the economy growing rather steadily, and they're trying to keep inflation down. All right? Well, let's say that we're in a really good time period, and people have lots and lots of money. Well, when we're in a good economic time period and people have lots of money, they tend to spend lots of money. And when everybody spends money, that causes inflation. Well, when we have periods of high inflation, then the government will actually raise interest rates. What does that do? Well, when they raise interest rates, then it becomes more expensive for you to buy your car. It becomes more expensive for you to buy your house. So interest rates will actually, when you raise interest rates, the level of inflation actually falls. On the flip side, if the economy is weak, when the economy is weak, people don't have a lot of money to spend, and so the economy slows down. Well, the government will do the opposite. When the economy slows down and we go into what's referred to as a recession, the government will actually lower interest rates. And again, when you lower interest rates, it becomes cheaper to buy a car and it becomes easier to buy a house. So when we have slow economic time periods, the government will lower interest rates in an effort to spur the economy forward. Okay, what ultimately makes bonds safe? Now, let's compare bonds to stocks. You can buy a stock, and let's say you buy a stock for $100 and it goes down. Well, when will it recover? You never know. Let's talk about, I'll give you an example. AT&T. Back in April of 1999, AT&T was trading for about $44. Well, that was April of 1999. Today, believe it or not, AT&T is, as of the timing of this video, as of the filming of this video, today AT&T is trading at about $28 a share. Well, it's 2025. So you bought AT&T in 1999 for 44, and today in 2025, it's trading for 28. So you haven't made any money for 26 years. And when will you make money? You just don't know. Well, the cool thing about bonds is bonds, when you buy a bond, you buy that bond for a set time period, okay? It's called the term, all right? So let's say you buy a 10-year treasury bond that pays you 10%. Well, not only will you get $100 a year for that 10 years, but in that 10th year, if all goes well, the federal government is going to give you your $1,000 back. There's a thing called a maturity date, and stocks don't have that. So with bonds, not only do you get interest, but you then, if all goes well, you eventually get your money back on the maturity date. What are the different types of bonds? There's three primary different types of bonds. The first is a treasury bond. Sometimes we refer to treasury bonds as T-bills. Well, the cool thing about treasury bonds is they're backed by the full faith and credit of the United States federal government. Because of that, we often refer to treasury bonds as being a guaranteed investment. Now, because they're guaranteed, they don't pay as high an interest rate as some other bonds, but it's pretty cool that they're guaranteed. They're very nice investments. The second type of bond that I want to cover today is called a municipal bond. Municipal bonds are issued by, obviously, municipalities, and municipalities issue bonds to pay for things like schools and airports and roads. Municipal bonds have a couple of special factors that make you want to buy them. Number one, because they're backed by municipalities, they tend to be a little bit safer. But also, municipal bonds are free of federal tax. And in many cases, municipal bonds are free of state tax. That brings us to the third type of bond, and that is a corporate bond. Corporate bonds, obviously, as you can guess, are issued by corporations. Now, because they're issued by corporations, corporations are certainly not backed by taxing power of municipalities or not by the taxing power of the federal government. So corporations tend to be a little bit riskier. But corporate bonds are rated. They're rated by three services. One service called Standard & Poor's, S&P, one service called Moody's, and another service called Fitch. And they rate bonds on a scale from AAA all the way down to D. Guess what D stands for? Default. You don't want to buy a D. So when we talk about bond ratings, they go AAA, AA, single A, all the way down to D. All right? Beware though, if you get a bond that's below triple B, so if you buy a double B rated bond, so you got AAA, AA, single A, triple B, if you get to double B, we refer to those bonds as junk bonds because they are so risky. You tend to want to stay in your A or triple B and up when you're buying a corporate bond. Now, earlier in the video, a few minutes ago, I talked about that thing called a maturity date. Let's review that really quick. All right. So you buy a bond for a 10-year treasury bond, and you get interest for 10 years, and then at the end of that 10th year, you get the value of the bond back. You get the $1,000 back. That's true for municipal bonds. It's also true for corporate bonds. So that maturity date is a really cool thing because it adds a very high level of safety. But the problem with mutual funds that invest in bonds is this. When you buy a mutual fund, you don't actually own the bond. You own a package of bonds. So you don't get the benefit of having that maturity date. You put the money in the mutual fund that invests in bonds, and it just goes and goes and goes. And yeah, you get interest. Sometimes you may get tax-free interest depending on the types of bonds, but there is no maturity date. So any financial advisor, as I like to say, any financial advisor that's worth their salt does not put money in mutual funds that invest in bonds. Buyer beware. All right, folks, thanks a bunch for listening. Please like this video. Please subscribe to my channel and look below to see my past videos, and I'll see you in another video in the future. Thanks a bunch.